automatic multiple ratio analysis.
Analyze tahleel.
Ratio analysis मालूम वाली GP 25-20%, NP 5%, other. Any idea? Studied before or not? Actually, there are 5 types. I will keep it very short, not to go into very detail. 5 types. One is profitability. Second one, liquidity. Third one, short-term solvency. Fourth one, long-term solvency. And the last one, capital ratio 1, 2, 3, 4, 5. These 5 types of ratios you should know. And this has certain equations. I will give the equation quickly and then we do the questions. So profitability. Video is running. First one, ROCE, return on capital employed. Profit before interest and tax divided by capital employed into 100. This capital employed is equity plus non-current liability. The total of these two comes here. So when you take the equity plus non-current liability and then the profit before interest, you divide each and then multiply 100, you get this. Number 2, GP is what? Gross profit ratio. Gross profit divided by sales into 100. Number 3, NP, net profit. Usually we take it profit before interest and tax. Divided by sales into 100. Then there is something called sales turnover ratio. What is sales turnover ratio? Sales over capital employed into 100. Capital employed, as you know, equity plus non-current liability. There is something called DuPont analysis, meaning you see, you take the NP, how much net profit over sales into 100, and then you take sales turnover ratio, sales over capital employed into 100. Now what you do, NP into sales turnover ratio. What will happen? NP over sales into 100. Actually, I'm sorry, here we don't get 100. We are not getting 100 for this. No 100. Answer is in times. So, into sales over capital employed. See here, we take these two out. You take these two out, what will happen? You get NP over capital employed into 100, which is this one. So you have an equation like this. NP into sales turnover is equal to ROCE. This we call it DuPont analysis. So this is all about profitability. Then we have, see, these things I am sure you studied in your school or university or somewhere. Only problem for you is the language. But have you seen these equations? Yes or no before?
Maybe.
Maybe. Good answer. Next one, short term solvency. short-term solvency is, we call it another name. Efficiency. First one is inventory turnover ratio. Equation inventory, average inventory over cost of sales into 365. Mention period. But if you want inventory turnover ratio, that is cost of sales over average inventory, that's it. First one, inventory retention period. How many days you are keeping your inventory in your warehouse? You buy, you sell. Between you are storing the inventory in your warehouse. How many days you are keeping? This is the calculation. Number two, it finds out how much time your cost of sales brings you sales. That is this. This answer is giving you in times, 2 times, 5 times, like this. Third one, receivable collection period. Yeah, sir, can you tell me an equation? Looking at this, any idea where you can bring an equation for receivable collection period? Receivable collection period is equal to average receivable divided by, please note, credit sales into 365 days. If I put 365, answer comes in days. But if I put 12, answer will be in months. If I put 52 or 48, answer is in weeks. You should understand that. So this is receivable collection period. Same like that, payable or repayment period, which is creditors. I will put average here. I will talk about average separately. Credit purchasers into 365. So there are actually 3 equations: inventory retention period, receivable collection period, and then payable repayment period. In addition, we talk about this inventory turnover. So next, this is what we call short-term solvency, or we call it efficiency. And then we have one more, third one, liquidity ratio. What is liquidity? One ratio is current ratio. Very simple. Current assets divided by current liability. Answer comes in day, times. 2 times 3. Now, for example, current assets 600 here, current liability 200. What's your answer? 3. 3 times. That's it. Next is what do you call that? Acid test ratio. Acid test ratio, which is current assets minus inventory divided by current liability. So this again same. You will get the answer in times. So this is liquidity. Fourth one, long-term solvency. There you have interest cover. The first one, in profit before interest and tax divided by interest. That's it. You take your profit and loss account, find out what is your profit before interest and tax, and then divide this by interest. You will get you how many times you are protected. Let's say your profit before interest and tax is 1,000, and the profit is 50. Sorry, interest is 50. So your answer is 20 times you are strong in terms of your business. So this is interest cover. Number 2, gearing. What is gearing? What we call that debts divided by debts plus equity into 100. Meaning non-current liability, loan, lease, finance, put everything together here. And then divide by the same total plus the equity. You all know what the equity is. Share capital and reserves. So into 100 you will get the gearing. For a company, if you have 30% gearing, how many percentage equity? 70%. So this company is good position or bad position? Good position. Whereas gearing is 60, equity comes 40. This company is in difficult position. It is too much loan. So that analysis we are doing, looking at this. Clear?
So the debts includes, what are the items? Debts include?
All non-current liabilities. Interest, actually interest bearing non-current liabilities. Generally all are interest bearing only. Lease, long-term loans, debts, debentures, bank loans, everything. And then you have debt to equity ratio. Same thing, equation is slightly different. Debt over E, that's it. The same numbers, you put it like this. And then you have, what else in this cover? I think that's all. Then we have capital ratio. First one, MPS, meaning market price per share. We have no calculation. You go to Doha, opposite to Toyota Tower, you have this, the group. I think here, somewhere here also you have the group. You see the numbers are going, stock exchange price, that price it is. This is market price per share. Number 2, EPS. EPS is earnings per share. This is there is the equation for this. There is no equation for this. Huh? No equation. From where you get? From the website or from the stock exchange. But earnings per share,
Profit after.
you get it, which is profit divided by number of shares.
So
This
this
is
profit
actually
means
profit after tax. So that is EPS. Then you have PE, meaning price earnings price earning ratio, P ratio, which is MPS divided by EPS. You have this number and then you have this number, you divide the one by one, you get EPS. Then you have dividend cover. Like interest cover, we have dividend cover, profit for the year, divide by dividends. You get this. And then you also have dividend yield. Which is dividend, same thing, profit for the year into 100. The opposite. And then dividend per share, DPS. Total dividends divided by number of shares. Anything else I am missing? I think that's all. Now we will try the question. Activity, but only 3 or 4 activities. We will finish it soon. See, I can give you homework also. They are giving you a question here, and then they are asking you to calculate all this. GP, operating profit margin, ROCE, current ratio, inventory holding period, payable repayment period, and interest cover. All of this I gave you equations. Can you try or you want me to do it? See, those equations, use it and calculate. Explain why it would be not relevant to calculate receivable collection period. Now they say that we should not calculate receivable collection period because in the balance sheet we don't have receivable. It's no credit sales, all cash sales I think. And then that's it. And activity 2. Activity 2 is there. Here is one activity, I'm sorry. How do the following users of financial statement benefit from ratio analysis? For each of them, shareholders, bank, employees, management, suppliers and government, if you have ratio analysis, will that be useful? You should write it. So that is anyway I am not going to discuss now. And activity 2 is there. So this is activity 2. Then activity 3. P company has the following working capital ratio. By the way, working capital is equal to current asset minus current liability. Now we have quick ratio. Quick ratio is another name for asset ratio. Receivable days, payable days, inventory turnover. Because the following statement is correct. P company's credit control has worsened. Can you say that?
Reduced.
See here what happened with the receivable days here?
75 to 65, reduced.
It is reduced. So credit control good or bad?
Good.
And then what about the payable?
also
Increase.
good.
It's good. And then current ratio also increase.
Increase.
So this statement is wrong. P company inventory is at a greater risk of obsolescence.
No.
Can you say that?
No.
No. P company paying its suppliers more quickly. No.
No.
P company working capital management and liquidity has improved.
Yes.
This is the answer. And what is this? The following extracts are from incoming financial statement. What is the ROC? Can you calculate please? That will be the final cost alarm of us. And then we should take a group photo.
Divided by
Put it in our Facebook.
22%.
22%.
20?
2%.
Everyone calculate. You to calculate not enough. Done? Not done? I'll give the equation again. They want profit before, sorry, what they want is ROC, which is profit before interest and tax divided by capital employed into 100. Now in this question, do you know how much is the profit before interest and tax? How much?
Before tax?
Yeah, profit before interest and tax. How much?
21.
21,000? 230. Is that right? Divide by. Capital employed, I gave you equation. Capital employed is going to be equity plus non-current liability. So sometimes, alternatively, total assets minus current liability. Same thing, huh? So, do you know how much is equity here?
96,500.
76,000?
96,500.
Equity.
Equities.
76,500 and the non-current liability 20,000. So total is capital employed is 96,500. So this will be 96,500 into 100. How much you get? 22. F3 theory discussion is over. Just to give a comment on our job.